In the bustling world of Wall Street, major indexes recently experienced a robust rally, with an over 2% rise. This rally was fueled by a concoction of factors, from falling U.S. Treasury yields to a weaker-than-expected manufacturing data output. As Treasury yields fell, the appeal of stocks at the dawn of the final quarter of the year surged. This comes as a breath of fresh air, especially after the U.S. stock market weathered 3 consecutive quarterly declines. The spotlight turned to rate-sensitive growth stocks as the reversal of a tax cut by British Prime Minister Liz Truss further bolstered their appeal. All 11 major S&P 500 sectors advanced, with energy taking the lead. Oil titans ExxonMobil and Chevron saw their stocks soar over 5% due to a leap in crude prices. In the realm of mega-cap growth and technology companies, giants like Apple and Microsoft also made notable strides. However, it wasn't all sunshine and rainbows. Manufacturing activity in September increased at its slowest pace in nearly 2.5 years, indicating a cooling demand for goods. In an unexpected twist, this negative economic data was perceived as good news for equity markets. The Dow Jones Industrial Average rose by 2.66%, the S&P 500 gained 2.59%, and the Nasdaq Composite added 2.27%. However, not all companies shared in the market's overall success. Tesla, the electric vehicle behemoth, experienced an 8.6% fall after selling fewer vehicles than expected in the third quarter. This turbulence in Tesla's performance was a stark contrast to the overall market rally. The rally's aftermath saw Citigroup and Credit Suisse revising their 2022 year-end targets for the S&P 500. The downward adjustment was attributed to aggressive central bank actions aimed at controlling inflation. Despite the rally, the road ahead might be bumpy, with potential interest rate hikes and a slowing economy. The Wall Street rally paints a picture of a dynamic and unpredictable market landscape, reminding us that in the world of finance, the only constant is change. Shifting the lens from Wall Street to the global stage, world stocks are holding strong near record highs. The dynamics of the global market are as ever-changing as they are interlinked, with political outcomes and economic policies playing a significant role. Take Japan, for instance. The country's Nikkei surged by 2.6% following the victory of the Liberal Democratic Party. The triumph of the ruling party not only bolstered hopes for political stability, but also fueled expectations of economic stimulus. On the flip side, we have Asia-Pacific shares outside Japan, which took a hit, falling by 0.3%. The reason? A contraction in Chinese factory activity. In the complex fabric of the global market, currency dynamics also play a crucial part. Post the Japanese election, the US dollar maintained its stance, staying stable, while the Japanese yen weakened. This shift in currency strength is a testament to how political landscapes can influence economic outcomes. And then there's the Federal Reserve, the proverbial elephant in the room. The Fed is expected to start tapering bond purchases, a move that's been on the horizon for a while now. This signifies a gradual winding down of the economic support measures put in place during the pandemic. But that's not all. The market is also anticipating rate hikes, with the latter half of 2022 being the likely starting point. In this global economic ballet, each country, each market, each policy decision plays a part, influencing the performance and direction of others. It's a complex, intertwined dance where every step, every move matters. As global economies dance to the tunes of politics and policy, investors worldwide wait with bated breath. The next move, the next turn could spell a surge or a slump. In the global market, it's all about staying nimble, staying informed, and above all, staying ready. Let's traverse to the land of the rising sun, where Japan's economy is predicted to slow down, but not without showing signs of resilience. Amidst global economic slowdown risks and supply issues for Japanese exporters, a contraction in industrial production is anticipated. Yet a glimmer of optimism persists as the third quarter forecasts a slight recovery. It's a roller coaster ride, with the ups and downs symbolizing the inherent uncertainties of the global economy. Yet the Japanese spirit remains undeterred. Expected consumption recovery is set to drive positive growth throughout the fiscal year, presenting a beacon of hope in an otherwise challenging landscape. However, the story doesn't end there. The rise in coronavirus cases adds an element of uncertainty to the mix. Despite this, household spending is predicted to bounce back, demonstrating the resilience of the Japanese people in the face of adversity. Now let's hop across the Pacific to S&P Global, a giant that has shown remarkable strength in the third quarter. Total revenue growth soared by 7.8%, beating consensus estimates and reaching a whopping $3.084 billion. This growth was supported across all segments, with ratings revenue and market intelligence revenue increasing by 20.3% and 8.1% year-over-year respectively. S&P Global's success story doesn't stop there. Earnings before interest and taxes, or EBIT, reached $1.45 billion, surpassing estimates, and the earnings per share, EPS, clocked in at $3.21, beating the consensus estimate of $3.04. In the face of adversity, economies and businesses alike demonstrate tenacity and adaptability, reminding us that the only constant in the financial world is change. That wraps up our financial update for today. It's essential to stay informed and make educated financial decisions in these dynamic times. Dive deeper into these topics and keep abreast with the latest financial trends by subscribing to our channel. Stay tuned, stay informed, and don't forget to hit that subscribe button for more financial insights. Until next time.